Well, good afternoon, everybody. I want to welcome you to our Eagle Wealth Management 2022 halftime webinar. And just getting started here, we're going to have Robert Meckstroth with City National Rockdale doing a presentation for us today. And he's just going to give us an update of kind of where we are through the first 6 months of this year. Obviously, there's a lot going on, and there is a lot more that we have updates just from even this last month. We're happy to have you. This video is being recorded, and so if you did want to share it or watch it at a later time, you will be able to have access to it as of Monday. We'll send out an email just letting everybody know that it is now on the website and live. So I want to take this time just to thank you for joining us, whether it's live or whether you're watching the recording. And just going to take this time to allow Robert to kind of give us the updates based on City National Rockdale's research. All right, Robert, thanks for joining us, and look forward to getting an update from you.
No problem, Chad. Thanks for having me as always. And again, thanks to everyone taking the time to join. Just one housekeeping item before we get started. If you do want to ask a question, just click on your Q&A button in the Zoom dashboard. You can ask that question. We will have time to probably get to all questions at the end, but do not hesitate. You can even, I think, ask the questions anonymously if you want to not have your name tied to it. Without further ado, let me dive into the presentation today. As Chad said, there's a ton to talk about. So I'm not going to go through every one of these bullet points here, the strategy considerations, but we're going to hit on the economic outlook. Where do we see things going during this time? And I think, the recession word gets thrown around a lot. Are we going into a recession? Are we in a recession? Get used to this word. I'm going to reference it a lot, mild recession, because I do think that's the most likely possibility at this point. And I'll tell you what that means, and then how we would want to be positioned given a mild recession outlook. And then investment strategy, that's what we'll talk about. How do we want to be positioned? I like this first line here. Historically, equities have declined 30-35% during recessions. Equities are down, depending on the sector, 20 to 30% so far already this year. So we're going to talk in the outlook that, the 6 to 9 month view, is fairly negative. But again, remember that oftentimes equities are forward looking as well. So given that equities are already down 20-30%, given a mild recession outlook, there are some stocks that are starting to look very, very attractive at their current levels. So I'm going to start with some of the forecasts. I call this the crystal ball page. Probably seen this if you've been on a few of these calls, and there's a few downgrades to some of the projections. One is just the economic outlook here in the U.S. Talk a lot about this today. What the Fed is doing, raising interest rates, means that the economy is likely to grow at a much slower rate. If not, have a period of a recession in this, 2022 to 2023 period. So basically assume that here in the U.S., the economy is going to grow at a very, very slow rate, if not at all. And then corporate profits, profits are not dramatically falling. I think that's a key, because a lot of talk about negative earnings, earnings missing estimates. But remember, a lot of the estimates are forecasting for companies to grow their earnings over time. Our forecast is for companies to grow their earnings at a much, much lower rate than what happened last year. Even, the low end of our projection in 2023 is that companies don't grow their earnings at all. But again, it's important to remember that even if companies are not growing their earnings, as long as they're still very profitable in many cases, as long as they continue to pay dividends as expected, there's potentially some decent buying opportunities in those stocks. And we'll talk about that a little bit more as we go forward. Inflation, obviously, it's probably the most talked about statistic right now for good reason. I mean, I can't remember a time where there was so much news around an inflation forecast release as there was this Wednesday, when we got an expected but shockingly high 9.1% inflation number. So this is one of the metrics that we've updated along with many others, in that inflation is going to be stubbornly high through the end of the year, even though it starts coming down. But the Fed is not acting slowly right now. They're acting more aggressively than anyone thought if you asked 3-4 months ago. And that is going to bring inflation down. Almost guaranteed next year, inflation is going to start to fall. So I think, if you have a forecast that inflation is going to be higher in 2023 than 2022, I think that forecast is wrong, because the aggressive actions that the Fed is going to take, it's going to bring inflation down. The question is the Fed going to bring the economy down too much through the aggressive policy? Because look at the interest rate forecast. Our forecast is for short-term interest rates to go all the way up to potentially 4% by the end of next year, which is a dramatic difference from where we were at 0% interest rates just a short time ago. So the Fed is taking inflation seriously. But what's really interesting to note is if you look at the 10-year Treasury forecast down here, and think of the 10-year Treasury as a longer-term interest rate. And a common misconception is that when the Fed raises interest rates, all interest rates are going up. But that's not necessarily the case. Look at how we have the long-term interest rates at actually lower levels than the short-term interest rates. That's what's known as an inverted yield curve. So when we talk about something like the 30-year mortgage, that's a longer-term interest rate. The 30-year mortgage has already jumped to 5+%. Even when the Fed raises interest rates a bunch more times, there's no guarantee that a long-term interest rate like the 30-year mortgage has to keep going up, because market forces have already adjusted those long-term interest rates. Remember that when you hear discussion about interest rates, that short and long-term interest rates are completely different animals. And that outlook will play a role in how we're positioning portfolios right now. So this is an interesting one to look at. It just shows potential economic scenarios. So, we forget we're still in a growing economy right now, but one that's rapidly slowing. The question becomes is, where do we bottom out? And here I referenced that mild recession a few minutes ago. I think that's the base case scenario right now, is that the economy does enter a recession either this year or sometime in 2023. But the key is that recession, in our opinion, is not going to be even a more normal recession. We think it has potential to be fairly mild. I'll give you the rationale behind that in a minute, but I'll compare this period with 2008 a lot. There's no indication to us that this has potential to turn into a 2008 type scenario in lots of different sectors, where, including the stock market, which was the 50% drawdown in 2008. So those of you who have been on these calls know the speedometers page very well. And the 6 to 9 month outlook, you're looking at more changes to this page than anything we've seen in a number of years, actually. A lot of indicators moving down. Many of the indicators, though, staying in the neutral category. And that's to be expected in a lot of ways. And I'll explain why. Inflation has been the outlier. It's moved into the red category as inflation pressure continues to grow. No real change in two of the biggest drivers of inflation. Last month, we talked about this. We said the war in Ukraine is going to press on. The lockdowns with COVID in China are putting pressure on prices. And those are two factors that aren't controlled by the Fed. But the real interesting one has been consumer spending here in the US and the job market here in the US, because these two green indicators have been surprising in a number of ways. And I'll go back to the consumer confidence spending here. It's been services activities that have been incredible. So Americans are back traveling, sporting events, concerts, bars, hotels. I mean, we saw some of these trends last month, but it's just continuing. And what's fascinating is there's no change in demand despite prices exploding higher. Air prices 30% plus year over year. Planes are packed. We're traveling at pre-pandemic levels. And that doesn't help with inflation. In fact, sometimes some of this good news that consumers still are confident enough to spend money on leisure, travel, hotels, bars, restaurants, it helps with, business profitability in many cases, but it hurts with the inflation story, because the market, everyone is looking for a sign of prices going down, and you just don't see it in the near term. And that's what's led the Fed to change their course of action, to basically put their foot completely down on the gas to get inflation under control. Because the Fed is saying, well, we're worried about inflation, but we want to watch the labor market and the economy. But what has happened in the job market? Month of June, we had another 300,000 jobs come back. We have the job market back basically to where it was before the pandemic, which is one of the healthiest job markets ever. So when you look at the Fed, there's two mandates: to keep the employment situation good and to manage inflation. One of those mandates is fine. The employment situation is good. The inflation situation is a disaster. So we'll show some of the data on this as we go through the presentation, but the Fed is intentionally trying to bring the economy down to get prices down. They want to cool demand. And look at the housing market as a great example. You raise interest rates, mortgage rates go from 3 to close to 6%, and of course, home sales start to drop. Inventory is up 30%. Sales is down around 30% nationally. Prices have remained fairly stable, which we'll talk about as well. That's one of the key differences between now and a 2008 type period, is we aren't likely to have a housing bubble. We aren't likely to have a consumer debt bubble, and we'll talk about that. But in some ways, this is what the Fed wants. They want some of these frenzy markets to cool down, housing being one of them. The aggressive tech stocks has been an area that too much speculation, money flowing into all the highest risk companies. That's one of the things our firm got right, in that we avoided the Teslas and the Ubers and the Peloton, DraftKings, Roku, Square, Spotify, Shopify, all those type of companies that were the highest growth, highest flyers. I mean, you look at that index of stocks, ARK Innovation Fund is down 62% over the last year. So, it's not a fun market, but if you were speculating on growth stocks, it's been a disaster of a market. Let's get into some of the data. So one of the interesting things when you forward look on inflation is commodity prices. Look at these two charts. Commodity index here, the CRB, all-time highs just as of a month ago. And then oil prices obviously have spiked to record levels. But look at the very near-term data in both of these charts. Commodity index is plunging, crude oil price dropping. This is not a supply situation. This is a demand reduction situation. So as the US economy slows, and in particular as the Chinese economy slows, we often think of things in a US-centric view. But the Chinese economy is the second biggest in the world. And these COVID lockdowns and economic slowdowns in China have potential to have a major impact on the price of commodities. So that's some good news that could be coming on inflation there. But that good news isn't going to make a huge dent, unfortunately, until maybe into 2023. So you had the May number. We had 8.6% on inflation in May. We got the 9.1% inflation number this month. So you can see our projection was for inflation to stay high, this month and probably into next month before you start seeing some signs of it dropping. But I think it's very important to note that when we start looking into 2023 now, I think I'm very confident to say inflation is going to fall pretty quickly, because the interest rate moves of the Fed are already having a big effect, and they will continue to have a big effect as they keep pushing rates higher. So I think, to me, the biggest risk right now is the Fed goes too far as opposed to the Fed not doing enough. Because the Fed knows they have to get inflation down, but they run the risk of raising interest rates too quick and too high that you actually bring the economy back into a major recession. So we have to watch that closely, but I am pretty certain that we will see inflation start to cool down in the start of next year. And we talked about this dramatic change in policy. This is why I'm so confident inflation is going to come down, because the Fed is not messing around. This is the Fed funds futures chart that reflects the market expectations for where interest rates end up. And look at the dramatic change all the way up to this 4% projection that we share, and look how quickly it happened. It's one of the fastest rate increase periods that we've seen. and even way more than the more laddered approach. Look at the difference with the last rate hike cycle. It's almost just like a stairs, just a rate hike every quarter, just consistently. This is a dramatic increase in a fast period of time. On the other hand, there's a second force too. It's not just interest rates. The Fed is reducing their balance sheet. This is a more gradual approach to balance sheet reduction, but that's just even more, easy monetary policy that's going away. So that puts pressure on interest rates again, as one of the biggest buyer of certain investments. The Fed is now a seller, or at least a reducer, that affects interest rates. So this is one of the things I think is not often talked about, but so important: consumer inflation expectations. So inflation is funny because when inflation expectations go up, it becomes a self-fulfilling prophecy sometimes. If people are expecting higher inflation, then businesses will raise prices and people are going to pay those prices, and it can become a cycle. So not only does the Fed want inflation raw numbers to come down, they desperately want to see consumer inflation expectations start to go down too. Basically to have people believe that prices are going down. This is one of the main reasons the Fed is being so aggressive, and they're considering a quadruple rate hike this month to really show the market that inflation is going to be battled. And this chart is a few weeks old. We've already seen the 5-year inflation numbers come back down again. So the Fed has been successful in starting to manage some of these expectations. And I think when you start seeing prices go down, you might see more of the consumer expectations in the near term start to come down a little bit too. Now, let's talk about the forces of inflation. So, we talk about the forces of prices in energy and food, but wages have been one of the interesting inflationary forces as well, because the job market has been so strong. Look at the job openings rate here. We have way more openings than we have as the required amount for the economy, and the jobs worker gap. We have way more jobs than we have workers looking for jobs. So what that leads to is it leads to wages going up. If you've needed to get employees in these tight labor markets, you've usually had to pay more. And again, I got this question in a meeting this morning. Well, isn't it good if workers are getting paid much higher wages so they can afford higher prices? Yes, in theory, that sounds like a good thing. But if you want inflation to come back down, higher wages are an inflationary force. If inflation's running at 9% and you're increasing wages 12% plus, prices are likely to continue to go up, especially in a tight labor market like we have. So what the Fed wants to see, and I think this is what we probably want to see as well, is we want to start seeing wages come down a little bit in line with inflation coming down without necessarily a spike in unemployment. And how that happens is just there's still this huge amount of job openings in this country, but you're starting to see the least profitable companies lay workers off. So think of Coinbase and Netflix and Tesla and all of these growth companies that are just getting hammered and have to cut costs. Well, those workers that are going on the market, they're finding jobs pretty quickly. So if you think of companies in the tech space that are the profitable ones that are still hiring, Amazon, Microsoft, Apple, Facebook, Google, these firms, were forced to pay outrageous wage increases to attract talent. And now as workers hit the market, they're not having to, necessarily raise wages as fast to attract employees. And you see this across sectors too. So what we want is a normalization of the labor market. We still want to be close to full employment, but we want to start making progress on inflation there. So that's a topic that I can have a whole webinar on the dynamics of the labor market, but I will spare everyone that for now and go into my two favorite slides, which clients of ours may have seen these over time, but the debt service ratio is one of the biggest differences between now and 2008. How much debt do consumers have relative to their income? And look at how low this number is still. So don't be, I think we talked about this last month. Don't be concerned when you see headlines that say consumers are taking on a lot of debt or taking on more debt. because look at how low that number was. Even if we take on, another $1 trillion in debt, you're not necessarily, trillion might be the wrong number there, but even if you see that percentage point go up where debt becomes, 10.5% relative to disposable income, I don't think you're quite at that warning zone. You're nowhere close to that 2007 type scenario. So we'd have to see this number really shoot out before we start worrying about consumer balance sheets. When you look at the cash in client bank accounts, or consumer bank accounts, it's still very heavy. I mean, we've started to see cash deposits come down a little bit. We start to see savings being spent down a little bit, but we're still looking at savings levels that are much, much higher, cash balance levels that are much, much higher than when the pandemic started. And granted, prices are higher. We've seen inflation go up, but still at the moment, consumers have, some built up defenses against higher inflation. But it just shows the urgency of why we need to get inflation down quickly, because this will not last. If prices continue to explode higher, we will see cash balances start to be drained, and that could put the economy in a bad situation. Another reason why the Fed is so aggressive. So I'm going to skip that one and go into the home building activity. We talked a little bit about the housing market, and you can see the interest rates down here. I mean, close to 6% on the 30-year mortgage. I mean, for people, that are younger, it sounds like an extreme number. I mean, for most of us, it's still a fairly low number, but it's having an immediate effect on the housing market. Look at the housing market index and single family home starts. The demand for homes is going down. So the only good news is you have this low inventory backdrop that is going to limit some of the downside there, meaning that we have not overbuilt when it comes to housing. Another key difference from 2007. And again, even if we get a 5, 10, 15, even 20% decline in home prices, most home buyers, most home owners, are still not going to be underwater on their homes. You're not going to see a foreclosure housing bubble type situation that you saw in 2008, at least with the current economic conditions we have. Now, this is something I referenced right out of the gates that said, kind of the normal bear market stock return is about 29%, minus 29%. So the average bear market recession return is a minus 35, and then bear market with no recession, minus 25. So, we kind of think, in this mild recession scenario, our forecast for stock prices is the minus 25 to minus 35% range. That's kind of where they bottom out, which is, we're kind of into that area now. We've seen stocks correct about 25% on the year, but for longer term investors, and most investors, when I say longer term investors, people who are going to be invested for more than 5 years, this starts becoming a very attractive entry point for stocks and quality companies, because the average return 12 months after stocks hit a bear market is a positive 15%. So it can take time. Obviously a 2008 type scenario takes longer to get a recovery, but history says anytime you're buying stocks in a bear market, it's a good decision. Now, we're not, again, calling to back up the truck and load up on stocks. In fact, with the tough economic conditions we talked about, we want to continue to be invested in quality companies, but I think you could see a lot more pain in the riskiest stuff before it gets better. But one thing that's clear is our firm view is you want to be invested in U.S. stocks. As a firm, we pretty much have eliminated all exposure to international stocks at this point. The euro just hit parity with the dollar. I think that's a testament to how negative the sentiment is in Europe right now. I don't have any interest investing in dollar in European equities, given all of the major risks there. Whatever risks we face in the U.S., I think Europe is dealing with, 5 or 6 more potential crises than we are here in the U.S. And then Asia's tough too, because historically we've liked parts of Asia, but with what's going on in China, the demand slowdown, the COVID lockdowns, that has potential. I mean, that has an effect on the world economy, but it really pulls down Asian economies as well. So we've done well. Look at the 5-year return. We've been underweight international stocks, relatively over the last 5 years, and that's paid off for us. But we continue to think the U.S. stocks have the potential to outperform. So when we look at earnings estimates, this is an interesting one too, because depending on what happens to the economy, that could really affect what corporate profits do. So I'm going back to that mild recession view, because again, I think that's the most likely scenario. And in that mild recession, companies, total earnings growth -1%. I think that's, very much within the realm of possibility. The market still is forecasting an 11% 2023 earnings growth when you look at the Wall Street estimates, and CNR is coming in well lower than that. So again, that leads us to be a little more defensive when it comes to our stock selection and positioning right now, given that earnings may disappoint. Today, we got the first taste of the second quarter earnings, and it wasn't great. Banks had a tough climate. I think a lot of sectors are going to show, maybe reduced growth forecasts. So just further reiteration of wanting to be invested in quality companies. So, I've already talked about this. Look at the percentage return in speculative technology stocks that are outlined in yellow. They exploded higher. Everybody wanted to own these tech stocks. And now the fall from grace has been just amazing. The drop, again, I mentioned the ARK Innovation Fund. That's the poster child for speculative tech, is down 60%. And now you've seen it really drop all the way down, to where it's barely outperforming the S&P 500 for the last 5 years. And like I said, that may get worse before it gets better, because the highest growth stocks are more sensitive to interest rates. So for us, you'll notice there's this digital revolution theme. That's our preferred way to invest in tech right now. It's higher quality tech companies. They still have growth potential, but you can see those have kind of been the winners over the last 5 years now that speculative tech has declined. So, I just continue to focus on quality. You see the highlight at the top, emphasis on quality, not only in our core equity, but with our dividend stocks as well. So those of you who work with us, know how much we like dividend stocks. And, even within the dividend stock universe, and the left side of this chart shows the price of the average dividend stock, where the S&P 500 is trading about 19 times earnings, the dividend stock index is about 13 times earnings. Even within that dividend stock universe, you can see the difference between our strategy in blue versus that Dow dividend index. We typically are focused on companies that are more stable in their earnings, more stable in their revenues. And that means more stable in their dividend payouts. So again, when you talk about a negative economic outlook, which is one we have, again, it's maybe not as bad as some firms' outlooks, but it is a negative outlook. But you're invested in companies that have very stable earnings growth, pay good dividends, maybe increasing their dividends. And that's how we build out portfolios in this type of economy, meaning that we don't want to sell out of the quality companies, but we want to have an individual stock portfolio that is a higher quality focus than what you'd see in the broad indexes at a time like this. So I'll hit on a couple more slides. I think just the performance numbers are interesting to look at, just how the markets have been doing. This slide goes back to 1980. It shows the annual return is the top in blue. The blue bars is the annual return for that year. The red dots are the biggest drop during that year. So just for example, we can look at last year. Last year, the biggest drop was only 5%. It's hard to see there, but the stock market was up 29%. This year, the biggest drop was 24%. We're down 23% for the year. So we're still kind of right at the bottom right now. We haven't seen any recovery. But equity markets, this is not out of the realm of possibility for equities when we go through history. We have many bear markets over the last 40 years that are referenced here. And after many of these bear markets are pretty quick, steep recoveries. Even the 2008 and 2021 or 2001 type major recessions, we've had, decent recoveries coming out of those. Now, again, we don't think this is going to be as bad as the 2001 or the 2008 type scenarios. But again, it's not without the realm of possibility on equities. But look at bonds. Bond returns this year have been well out of the range of normal. Minus 12.6% on the Bloomberg Aggregate Bond Index, a portfolio of fairly conservative corporate bonds. You really have never seen returns this poor in traditional bonds. And why is that? Well, interest rates going up so fast negatively affect traditional bonds. So it's one of these crazy years that if you called us up at the end of last year and said, put my money in all traditional bonds, I think the market's going to drop big. Well, even if you put all your money in the aggregate bond index that was, supposedly a lot safer, that portfolio is down, 12% this year. But notice, look at what happened in 1980, the last time we had some of these really big decreases in bonds. Look at the recovery of bonds kind of right after that. You had some huge returns in bonds. I'm not saying bonds are going to give you interest rates are a lot different back in 1980. You're not going to get a 32% return in traditional bonds, but you're now starting to see some opportunities in conservative investments again. It's the only good news about what the Fed is doing and what's going on in the economy is that you can invest conservatively again and get some bang for your buck. So we are starting to see some attractive opportunities in traditional bonds for the first time really in a number of years. And, for certain clients, it might make sense to add some exposure there. I'm going to skip that one and go to this one and talk about the 10-year Treasury yield. This is the outlook for long-term rates. And, long-term rates have already moved up. The 10-year Treasury is back to 3%. But, our range is that long-term interest rates still have some more room to grow. So if you are investing in bonds right now, we typically like bonds that are shorter in duration, meaning that they mature in just a few years, as opposed to going out and buying a 10-year or 20-year bond. And then when it comes to opportunities in the bond market, I really think one of the greatest opportunities still is the higher risk, higher yielding bonds. And right now, when you look at bonds, we have high yield corporates, leverage loans, and municipal bonds outlined here. And this shows default rates. So over the last 12 months, we've really seen no defaults, even in the highest risk bonds, despite everything that's going on. In 2020, in the pandemic, you saw some corporate bonds defaulting at higher rates, but a lot of those were in the energy sector. And remember what happened with energy bonds back in 2020, energy prices plunged. It's the opposite right now. So I'd say the most likely path for default rates might be more in this recessionary environment type range, which, given the interest rates you get on higher risk bonds, if default rates come in at these levels, your returns should be very good over the next few years in this category. So kind of bottom line then, summarizing what we want to do with portfolios in this market is, on the stock side of things, US focused stocks, quality stocks. Now is not the time for us to go out and sell Costco and Walmart and Home Depot and all these quality companies. We like owning those type of companies in this environment. On the bond side of things, we finally have opportunities to find interest rates that work. The high yield interest rates are really attractive, come with a little more risk, like those a lot. Traditional bonds for certain clients, now you're actually getting paid enough to go into some of those. So Chad, I'm going to turn it back over to you. I think that was a lot of information there, and maybe we'll take any questions that have come in now.
Thanks, Robert. That was a lot of information. I know a lot of updates based on from City National Rockdale. You and I have had quite a few conversations regarding those speedometers and the fact that, we probably thought the changes were going to come. They're here now. We're seeing it, and what we're kind of looking at. I love the slides really just talking about the fact of how normal we've seen over all these years, going back over 40 years to 1980, that these drops are. And then what we typically see afterwards. And really think the most powerful slide you had that City National Rockdale and you put together was that one, just kind of talking about what the returns are the next 12 months on average after we have seen those drops. So thank you on that. Obviously, the questions always, a lot of the questions come out are typically around inflation. And what we're kind of seeing now with this 9.1 that just came out a couple days ago, that obviously was a little higher than expected. But on our end, when we're seeing it, we are starting to see gas prices coming down. Oil has gone from $130 a barrel down to less than 100 here recently. Grain and corn, and we're seeing significant drops of 20, 30+%. How are we is City National Rockdale talking about kind of more of like what we're seeing now versus this kind of most recent 9.1 number?
Well, you're spot on. I mean, we had this chart here that started to show that if we go back to the inflation stuff, where you're starting to see these commodity prices drop, and the current inflation data just doesn't pick that up yet. So that's why I think, if you're seeing that 9.1% print and thinking, next month it's going to be 11%, I don't think you're looking at it necessarily correctly. I think you're going to see some price relief start to show up. The challenging thing with commodities is they are volatile. So they can, spike just as quickly as they drop here. But I think going back to the slides, the demand side that's really changed. So, we're just not demanding as much in these commodities. And, food and energy, we can exclude, but a lot of them like steel and iron and, some of these, components of chips that were in so high demand is, that's where you're starting to see some of the drops. And I think that will continue. And it's just another good, reason, Chad, for investors that are trying to hedge against inflation. We always talk about that commodities are always talked about as a good hedge against inflation, but they can set you up for big losses when things go, even at a time when inflation is high. Because if you've had a basket of commodities, in a fund over the last couple of weeks, you've seen some pretty nasty returns in some of those categories, even with some high inflation data.
Yeah, I find it seems kind of counterintuitive. I've had so many conversations with clients here over the last 6 months where they're like, we just got to buy gold, we got to buy silver, we got to buy Bitcoin to protect for that, because there's all this conversation that's what it helps in high inflation. And gold has been coming down, silver has been coming down. Obviously a lot of now we're starting to see a lot of the commodities are coming down really quickly, including oil. So this is kind of coming back, and where we really focus on our firm is really on the financial planning with all of our clients. And this is what I love with the slides that you're sharing, is it really brings in the long-term track record, that we're not in this recency bias that just because things are not looking great right now, that they're not going to look great forever. And this is those opportunities. And so really appreciate the partnership we have. I don't think we have really any more questions right now. No open questions on that. And it's this was just a great, just recap and touching base and getting an update just of where City National Rockdale is. I appreciate the time.
No problem, Chad. I figured out the key to preventing questions. If we have a slide on every single topic and go through it, then I find the most common thing I hear from people is you kind of hit on everything. I think, you talked about all the things. So, but if there is a question that you come up with that you forgot to ask, just, I know you can email Chad and Suzanne and the team, and we can always answer it for you offline.
All right. I appreciate the time. Have a wonderful rest of the week, and we will talk then.
Thanks so much.
All right.
Bye-bye.
Take care.